welcome to Personal Finance. I'm Gugulethu Cele. Now today you can tell that we come from a very different and slightly unusual setting. That's because we're at the Discovery Financial Planning Summit for 2015 at the Sandton Convention Center. I've got two very important guests with us today who are going to tell us more about the nuts and bolts of ensuring that you plan for your retirement perfectly. First, I'd like to introduce Adam Halper, no stranger to the show. He's a financial planner with Discovery, and Howard Sharfman. He is from the NFP Insurance Solutions based in the US. Gentlemen, thank you so much for joining us today. Good to have you. The nuts and bolts of retirement, and I take it retirement is one of those topics that never gets out of fashion. But Adam, let's start off with you from your perspective. The key considerations that one needs to take into account when planning for their retirement, what do they entail?
Ideally, what one should consider is the time they have, because time is a huge factor with retirement. I often say to people, you start off, what matters is when you start off, because essentially your retirement age is going to be exactly the same. Your year that you're going to be retiring in will be either between the years, well, in South Africa, between the years of 55 to 65 from a working situation. And all that is changing is the time that you have left to get there. But that retirement age is staying exactly where it is. So you have to save, and if you want it to be easy, then you should start early.
The earlier you start, the better, but the truth of the matter, Howard, is that a lot of consumers across the globe don't always start timeously. Is there an opportunity to catch up?
There's always an opportunity to catch up, but you also have to look at your income needed at retirement and through your retirement. And there are peaks and valleys in that. Inflation is part of it. But once you figure out what you need to retire, we work backwards. So if someone needs in the United States $50,000 to retire a year, we have to figure out what type of corpus one would need, what type of investment pool they need, so we are able to generate $50,000 worth of income. We take into consideration debt, we take into consideration inflation, but there's always time to catch up, but it's very difficult. We call it the stuff theory. There's too much stuff in this world in which people want to buy. And every dollar that you spend on stuff is a dollar that you can't spend on retirement and paying yourself first. So we're always trying to get our clients to pay themselves first so they could save for retirement.
I want us to explore that theory of the eighth wonder of the world, compound interest, which obviously, coming back to Adam's point, the earlier you start, that will naturally work in your favor. And maybe it's a concept that a lot of clients that you might deal with fail to understand sometimes, or don't really pay attention to.
It's an amazing factor. As Albert Einstein says, it's the eighth wonder of the world. And what we find, people who we meet in their 50s and their 60s, if we look where they have money, they have money in just a few places. They have money in their equity in their home. They have money in their qualified plans, or what we call 401k plans in the United States. And they have money in their life insurance policies. They have money in those three places because, one, they're all forced savings. You pay your mortgage every month. Money comes out of your check to go into your qualified plan, and you pay your life insurance. But what happens is that money grows with compound interest. So when we look 20 years after people have started, they have significant funds of money in these investment vehicles. They didn't think of them as investment vehicles, but they turned out to be one. So what wasn't important is if your home went up 2 or 4 or 6% a year, or the return on your 401k plan, or the rate of return on your life insurance, because you didn't save other places. So yes, looking back, there might have been a better place to save money if you were diligent enough to do that, but most people aren't. So the fact is, one, you have to put your money in play and you have to watch it compound, and then you have to make sure stuff doesn't get in the way of taking money out of your retirement before you retire.
There was something interesting that you mentioned, which was forced saving. And Adam, maybe this brings us to the incentives that need to be provided to consumers to actually go ahead and start planning and saving for their retirement. Maybe if you can paint an overview of the importance of incentives, especially in the South African market with the different product offerings we have.
The retirement annuity is a product which allows people to take advantage of a tax deduction. We have no other tax deductible saving in the market when you look at savings products. And the reason, I think that is a huge that is a huge incentive, because everyone pays tax on their income, and that is not negotiable. So if you're going to be paying the tax, why not put it into something that is a pocket for your old age, if you can, instead of pay it to the tax man? I think it's a huge incentive, and to structure and a lot of people are unaware of that. And I think it's critical that people understand that if you're paying tax and you don't have a retirement annuity, you're literally throwing money away. Or paying it to the tax man, whatever. Maybe that's the same thing. No, maybe not. I'll get shot for saying that.
Maybe not, exactly.
Yeah.
But clearly then, on these incentives, what I also want us to explore is the different product offers. Because you have your provident funds as well as pension funds. As South Africans, are we capitalizing on these offerings enough?
I don't feel that we are. I think it's critical that people treat retirement or pension or provident funds with far more retirement planning, because I can tell you that the pension and provident fund values, 9 out of 10 of them are cashed in the minute that person leaves the employer. And we
see that in the public sector in South Africa, right?
And we've seen that everywhere, exactly. So it's a very, very popular trend. They'll either redo their home, or they'll buy a new car, or they'll settle some debt, which is not necessarily a bad thing if you look at now. But if we're talking retirement, which we are, it's a terrible thing, because all they're doing is starting back at square one with less time.
Howard, I'd like to get you into this part of the conversation as well. We take a look at that ill-disciplined behavior, if we can refer to it as such, where there's a lack of commitment on the client's part, as Adam alluded to, people who withdraw from their pension or provident funds and fix up their homes.
It's good public policy to make sure that people continue to save, because if people aren't able to save on their own, they're going to look to the government for that help in retirement. And so it's these tax deductible savings plans that you have, that we have in the United States, are great public policy. People have to pay attention to them, especially if there's some sort of match from an employer. You're being allowed a 40% return in the United States if something's deductible. That's better than any investment, and the government felt it was good public policy. And if you combine that with saving first, saving for retirement first, and not taking money out, you'll get there. It's a slow and steady pace. But it's interesting, just yesterday in London, or 2 days ago in London, I was in an Uber. And I believe you have Uber here in South Africa. And my Uber driver I started to speak to, and I asked, how long have you been working for? He said, I work part-time, and this is my retirement money. I said, explain more, because that's the business that I'm in. And he said, I could work 3-4 hours, 2 days a week, and I've earmarked all of that money for retirement. He said, I get to meet interesting people, I like driving my car, and I get to save for retirement. So there's lots of creative ways to save for retirement, but he figured out, and he looked to be about my age. He had 10, 15 years to go till retirement, and he's taking it seriously. So clearly, this is a topic that's on a lot of people's minds. It's so important because it's scary. For someone to have worked their entire life and always had a paycheck, always made a living, was always able to support their family, to go into retirement without a significant investment portfolio is scary. So people, when they start to think ahead, usually it's too late, but they want to do something about it, and there's a lot of opportunities right now to do that.
Which we certainly hope a lot of people will make use of. I want us to venture into that a little bit more, Adam, because we always hear about the 15% of one's income that needs to be contributed. Is this a red flag for South Africans and people across the globe, that where you can contribute more, go ahead and contribute more, and as Howard alluded to, find alternative means of increasing the savings that you have in retirement?
I don't think retirement annuities are necessarily the only way to save for your old age. They are certainly part of the picture, and they should be quite a big chunk of it. And which is why I always believe there will be room for a professional or a financial planner who will help you explain, or who will help you understand exactly where your maybe putting too much away, possibly too much on the retirement planning. I haven't seen a lot of that, but it does occasionally happen where people are entitled to a certain tax deduction and then they can't get back more than that. Might be better for them to put their money in their home loan or in their, and I think it's very, very individual specific. I don't think there's a uniform solution for each and every person out there. Everyone's got different expectations. So from a retirement planning perspective, I think it's critical that a proper analysis is done with a financial advisor to better understand that individual need.
Coming back to individual need, as you've both alluded to, planning for your retirement is it's a journey, quite clearly, that spans well over 40 years. But what if you're running the last lap of that particular game and you're on the doorstep of retirement? Adam, are there ways that you help advise clients to hopefully beef up and fix up the nuts and bolts of their retirement planning to make sure that they live a comfortable life?
It's a very sad situation when you go and when I walk into a new client's home and they hadn't taken it seriously. People who had saved, who had made a lot of money but hadn't saved any of it or very little of it. And to sit there and expect me to come up with a solution to fix it, it's virtually impossible because it's already too late. And I think, and I might have maybe said this in the past, insurance is something you can't, that's why retirement planning falls under insurance. It's the only thing you can't actually buy when you need it. It's something you can only take care of when there isn't necessarily a need for it as such.
How would I take it you agree?
I absolutely agree. There are many times you need to buy something when you don't want it or need it to have it when you need it. And at the same time, we find people haven't saved for retirement and they're looking at retirement. There's two things they could do immediately. One, they could look at their spending and their cost of living, possibly downsizing in a home before it's too late. Save those last couple of years that they still have to work if they could downsize. The last thing that we see are family members who take advantage of other family members in terms of borrowing money, in terms of loans, and everyone wants to help and everyone wants to be nice, but sometimes we have to take care of ourselves first, and we have to make sure that we have enough money in savings to retire.
Exactly. It's a topic that can go on for days, and unfortunately we don't have that time. But thank you so much for joining us today. It does seem as though the key considerations to take into account is understanding your plan that is unique to your retirement needs, understanding the products that you invest in, and most importantly, start as soon as you can. A big thank you to both my guests today, Adam Halper, who's a financial planner with Discovery, and Howard Sharfman. He is from NFP Insurance Solutions based in the US. For Personal Finance, I'm Kukuletu Tele. We'll speak to you next time.